Welcome to Tech Money Madness, your daily U.S. stock market deep dive, July 23, 2026.
And it is quite a day out there.
It really is. Today, American Airlines and Tesla are bleeding billions of dollars in market value.
Yeah, and it's happening for the exact same reason that a gallon of milk at Albertsons just got noticeably more expensive.
Right. We are looking at a $100 oil shock that is completely fracturing the AI boom.
It really is.
If you were trying to make sense of your portfolio today, well, you are seeing a massive glaring divergence.
You're seeing a broad S&P 500 sell-off right alongside rising inflation fears.
Exactly. And that's all hitting the tape on the very same day that select AI infrastructure stocks are just rocketing.
While at the same time, the consumer-facing tech giants are shedding, hundreds of billions in value.
It's like a market suffering from acute schizophrenia.
That is exactly what it is. I mean, we are seeing institutions violently repricing the entire macroeconomic environment. But simultaneously, they're trying to figure out who is actually going to survive this next phase of the artificial intelligence build-out.
So to understand that survival game, we really have to start with the macroeconomic floor basically falling out from under the broader market today.
Yeah, we have a jarring geopolitical shock dictating the terms for everything else right now.
We do. Brent crude officially crossed $100 a barrel today.
Which followed those reports of oil tankers being struck off the coast of Saudi Arabia.
Right. And because of that, we are seeing a broad S&P 500 sell-off. The briefing notes actually mention that traders are nervously eyeing what they call risk pivot levels.
Yeah, for future volatility.
But let's unpack the mechanics here. I don't want to just say traders are nervous. What is actually happening at these risk pivot levels on the trading floor?
Well, it comes down to dealer positioning in the options market.
Okay.
When you have a sudden macro shock, like $100 oil, institutional investors rush to buy put options to hedge their portfolios.
Right. They want downside protection.
Exactly. So the market makers, the dealers who sell those puts, they are suddenly exposed.
And they don't want that risk.
No, they don't. So to remain delta neutral, those dealers have to short the underlying S&P 500 futures. And those risk pivot levels are just the mathematical thresholds where dealers transition from providing liquidity to aggressively selling.
They're selling into the weakness just to cover their own exposure.
Right. If the index breaks below those key moving averages, the selling becomes self-fulfilling. It accelerates dramatically.
Which means the floor drops out entirely.
It does.
And the catalyst forcing everyone to buy those puts in the first place is, well, it's the Federal Reserve.
Always is, right? Yeah.
Because of this sudden oil surge, the bond market is now pricing in massively elevated odds of a Fed interest rate hike in September.
That's the direct transmission mechanism. I mean, geopolitical energy shocks instantly reprice inflation expectations.
Because oil is the baseline input cost for everything.
Everything.
Yeah.
Global manufacturing, shipping, aviation. The market isn't just reacting to the isolated cost of a barrel of crude.
Right.
It is reacting to the fear of the Fed's reaction function. The Federal Reserve simply cannot ignore a supply-side inflation shock.
I would argue they're trapped. I mean, the market had been pricing in a predictable rate environment, maybe even a pause.
Yeah, people were comfortable.
But if the Fed has to hike in September to fight oil-driven inflation, borrowing costs just explode.
And that brings us right to the bloodbath in the tech sector today.
Exactly. When interest rates go up, the discounted cash flow models, the DCF models that Wall Street uses to value these massive growth stocks, they get absolutely crushed.
The math on that is just brutal.
Break it down for us.
So when you run a DCF valuation on a high-growth tech company, you are estimating their cash flows maybe 5 or 10 years out.
Right.
And you discount them back to today's value. But the denominator in that equation is the risk-free interest rate.
Which is tied to the Fed.
Exactly. When the Fed hikes, that denominator grows, and the present value of those future tech profits shrinks drastically.
So a dollar earned in 2030 is suddenly worth significantly less today.
Yes, which perfectly sets up the violent collision we saw with earnings season today.
It really does. The narrative jumping out of our stack of sources is this incredibly sharp divide.
A massive divide.
We have companies building AI infrastructure versus the companies spending on it. Let's look at the winners first.
Intel was a huge winner today.
Yeah, Intel jumped 11% on strong earnings and guidance. I mean, they're generating verifiable hardware revenue right now.
They are selling the physical architecture of the future.
The pickaxes for the gold rush.
Exactly, the pickaxes. And the market is rewarding them because that revenue is hitting the balance sheet today. It doesn't need to be discounted 5 years into the future.
But then you look at Tesla and Alphabet.
The other side of the coin.
Yeah, they were among the top losers today. I mean, shedding hundreds of billions in market value post-earnings.
And they plunged specifically after signaling even higher capital expenditures on AI.
Which is wild. I look at Alphabet's AI spending like, building a massive state-of-the-art nuclear power plant.
That's a good analogy.
They are pouring tens of billions into these data centers, but Wall Street is panicking because they haven't laid the consumer power lines yet.
Right. There is no clear mechanism for how the everyday user is going to generate the revenue to pay for that plant.
So it's a duration mismatch.
It is a severe duration mismatch. Alphabet and Tesla are outlining massive CapEx burn rates today.
In a market where the cost of capital might spike if the Fed hikes?
Right. They are promising that these investments will eventually yield revolutionary consumer products like fully autonomous robo-taxes or, next-generation AI search monetization.
But the timeline is incredibly murky.
Exactly.
Though I do want to push back on that murky narrative just a bit.
But really, how so?
Well, if you look at the actual briefing for Alphabet, Google Cloud CEO Thomas Kurian explicitly noted that existing B2B customers are spending roughly 50% more than previously committed.
That is true. The enterprise side is growing.
Right. So the infrastructure is actually paying off on the enterprise side. Isn't Wall Street just being myopic?
I wouldn't call it myopic, honestly. No, I'd call it a ruthless repricing of patience. You are right that the B2B cloud segment is thriving.
50% jump is nothing to sneeze at.
It's great, but you have to weigh that incremental cloud revenue against the sheer staggering volume of the aggregate capital expenditure.
The tens of billions going out the door.
Exactly. When a company is spending at Alphabet's or Tesla's run rate, a 50% bump in one enterprise segment just doesn't offset the fear.
The fear that the consumer applications won't deliver margins anytime soon.
Right. In a high-rate, uncertain macro environment, investors lose their nerve.
They don't want to fund your 10-year science project.
They really don't. They want free cash flow today.
So, the market is essentially dictating that if you want to survive this volatility, you need immediate enterprise reliance.
Or you need to completely overhaul how you capture consumer cash.
Which is why the ripple effects in today's briefing are so fascinating. We are seeing a mad scramble to forge new partnerships and lock in recurring revenue.
It's defensive maneuvering across the entire tech sector.
They're trying to build moats.
Exactly. Building moats before the macroeconomic water level drops any further.
Let's look at the specific mechanisms of these partnerships. Cerebra's was another top gainer today on news of a partnership with AMD for their AI systems.
Yeah, that was a big mover.
Why this specific pairing, though? Like, what is the strategic mechanism here?
It is a direct attempt to bypass the NVIDIA bottleneck.
Okay, interesting.
Cerebra's builds these massive wafer-scale AI chips. They are incredibly powerful, but they require very specialized infrastructure.
So they need a partner with a footprint.
Right. By partnering with AMD, they can integrate their accelerators with AMD's EPYC enterprise processors.
Which already exist in server racks everywhere.
Exactly. They are offering data centers an alternative ecosystem. It's a pure B2B play that locks in enterprise spending.
Which, just like we talked about with Intel, is exactly what the market is rewarding right now.
Precisely.
And we are seeing similar ecosystem land grabs everywhere. The briefing notes cloud gaming is seeing strategic pivots.
Yeah, Amazon and Microsoft are actively targeting different demographics.
Right, trying to carve up the market rather than fighting a margin-crushing price war.
Makes sense in this environment.
And Ford is planning to integrate Apple Maps software into its self-driving tech for their new EV platforms.
Locking in those partnerships.
But if you want to talk about building a fortress against macroeconomic shocks, the consumer play from Apple is definitely the most telling.
You're talking about the Klarna leasing program.
Right. Apple was one of the most active stocks today, and they are launching a device leasing program with Klarna to accelerate iPhone upgrades.
And smooth out demand.
Yes. They are transitioning from a cyclical hardware sales model to basically a software as a service model.
They're turning a $1,000 luxury smartphone purchase into a perpetual, $70 a month utility bill.
If you are looking at your own portfolio today and wondering why Apple might weather a consumer recession better than others, well, you have to look at this deal.
You really do. By transitioning the consumer into a leasing program, Apple is securing MRR, or monthly recurring revenue.
And Wall Street loves MRR.
They assign a significantly higher valuation multiple to it because it is predictable.
Right. If we get a Fed rate hike and inflation bites into disposable income, a consumer might just delay upgrading their phone for 2 years.
Which destroys Apple's quarterly earnings in a traditional sales model.
But in a leasing model, the revenue stream is completely insulated from those peaks and valleys.
Exactly. They are structurally changing the elasticity of their product.
It is brilliant, but it also screams of internal anxiety.
Oh, absolutely.
Apple doesn't want to rely on the consumer's disposable income right now because they see what's happening at the grocery store.
The grocery store is the canary in the coal mine.
It is. Which brings us to the final and arguably most important piece of this deep dive.
The consumer squeeze.
Right. The economic pressure Apple is trying to engineer its way out of is actively crushing the everyday consumer sector right now.
And it proves that the broader anxiety we are seeing in the S&P 500 is entirely justified by the data on the ground.
Let's talk about consumer staples.
They are the ultimate leading indicator for economic contraction, and the margins there are just breaking down.
According to the daily briefing, Albertsons stock plunged today due to weaker grocery spending.
It is severely cutting into their sales and earnings.
And it's such a wild contrast. We just spent 15 minutes talking about tech giants dropping tens of billions on AI supercomputers.
While the everyday consumer is visibly struggling to afford basic groceries.
Exactly. So what is the actual market mechanism driving the Albertsons plunge today? Is it purely the $100 oil we discussed at the top of the show?
It is the direct consequence of input cost inflation meeting consumer exhaustion.
How so?
Well, when Brent crude hits $100, the cost of freight, refrigeration, packaging, all of it spikes.
So Albertsons faces higher operational costs.
Right. And normally they would just pass those costs on to the consumer by raising prices on the shelf.
They can't do that anymore.
No, we have hit a breaking point in elasticity. Consumers simply refuse, or they are just unable to accept higher prices.
So they change their behavior.
Dramatically. They trade down from premium brands to store brands. They buy fewer items per trip.
They cut out high-margin discretionary items entirely.
Exactly. And when that happens, the velocity of money within the grocery sector slows down, and Albertsons' profit margins collapse.
The market is punishing their stock today because it recognizes that the consumer has basically tapped out.
Tapped out completely.
And if discretionary spending is vanishing at the grocery store, well, it is completely dead for luxury services.
Absolutely.
Which explains American Airlines showing up on the briefing as one of the top losers today, right alongside Tesla.
Yeah, airlines are facing a brutal double whammy in this specific macro environment.
Because their input costs are exploding while their revenue base just evaporates.
Precisely the opposite of a Goldilocks scenario.
Right.
Their biggest operational expense is jet fuel, which is surging in tandem with the Saudi tanker news.
And if they haven't aggressively hedged their fuel contracts, their operating margins are immediately compressed.
At the exact same time, the consumer who just traded down to generic cereal at Albertsons is canceling their summer vacation.
Surging costs meeting collapsing demand.
Exactly.
It really connects the entire board. I mean, oil goes up, groceries get more expensive, Albertsons plunges, discretionary income vanishes, and American Airlines tanks.
Everything is interconnected.
But the pressure on the consumer isn't just financial today. It is systemic.
Very true.
The briefing highlights a cyclospora outbreak that is currently presenting a major test for the new administration's promise to overhaul the food system.
And to rebuild trust in the CDC.
Right. Now, obviously, we're just impartially reporting the facts of the outbreak and the administration's stated promises here.
Of course. We're not taking a side on the politics.
Exactly. We have to look at this strictly through the lens of market psychology and the velocity of money.
Right, keeping it entirely focused on the systemic economic impact.
The administration made a specific promise regarding food safety, and this outbreak is a real-time, highly visible stress test of that infrastructure.
And when you evaluate the consumer landscape, public trust acts as an economic variable.
Because wallets are already squeezed tight by inflation.
Exactly. When a prominent food safety issue dominates the news cycle, it compounds consumer anxiety.
So a shopper who is stressed about their grocery bill is now actively questioning the safety of the supply chain itself.
Which reinforces a defensive, cautious psychological mindset.
They stop buying fresh produce, they retreat to processed staples, or they just pull back their overall economic footprint.
It pulls even more velocity out of the economy.
Wow.
Yeah. When institutional trust wavers during an inflationary period, capital stops flowing freely. It is a compounding effect on the macroeconomic slowdown the Fed might be forced to engineer.
It's a perfect storm of pressure on the average household. And it dictates exactly why the tech giants are scrambling to lock in enterprise contracts and leasing models.
They see the writing on the wall.
Let's pull all of this together because the divergence we set out to understand at the beginning of the show is actually a perfectly logical, albeit ruthless, chain reaction.
The market is functioning exactly as it should under extreme stress.
Isolating immediate cash flow and punishing speculative duration.
Yep.
So if we synthesize today's sources, the roadmap for the rest of 2026 is really defined by three interconnected themes.
Right. First, we have deep economic uncertainty sparked by the geopolitical shock of $100 oil.
Which is terrifying traders because it forces the Fed into a corner regarding September rate hikes.
Second, that macro fear is bleeding directly into the everyday economy.
Crushing consumer staples like Albertsons and discretionary plays like American Airlines as inflation exhausts the public.
And third, that exact economic anxiety is causing the massive AI divide in the tech sector.
Right. The market is aggressively rewarding the pickaxe sellers. Companies like Intel generating immediate B2B infrastructure revenue, or Cerebra is forging enterprise partnerships.
But it is violently punishing the massive, debt-heavy capital expenditures of consumer-facing giants like Alphabet and Tesla.
No matter how much their underlying cloud metrics are growing.
Everyone's trying to build a moat, whether it's Apple transitioning you to a Klarna leasing model or Ford locking in Apple Maps.
It is a brutal environment for anything that requires a leap of faith.
The market is demanding proof of concept today, not tomorrow.
So as we wrap up this analysis, I want to leave you with a final thought to mull over on your own.
It's a big one.
We have dissected the multi-billion-dollar AI CapEx burn rates, and we have looked at the reality of the consumer trade down at the grocery store.
The defining question for the tech sector isn't whether they can build these massive AI models.
It's who they are building them for.
Think about it. If the stock market is currently rewarding this massive, expensive build-out of enterprise AI infrastructure, but the actual everyday consumer is pulling back on basic grocery spending,
Who is going to be left with the disposable income to eventually subscribe to the AI software and autonomous services these tech giants are spending hundreds of billions of dollars to create?
if the end user is broke, the entire infrastructure stack is built on sand.
That is the multi-billion-dollar question, and it is going to dictate market leadership for the next decade. That's all for today's deep dive into tech money madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.